Making money and creating wealth are two different things. The majority of us just focus on making abundant money, and only a few smart people believe in creating wealth. However, the good news is that we have found a time-tested formula to create wealth without putting too much effort. Hello there. Welcome to Stack and Invest, the channel where financial freedom meets the power of knowledge. Today in this video, we are going to talk about the adorable formula, the 8-4-3 rule of compounding. Moreover, if you stay with us till the end, you will get a proper idea on how to apply this formula accurately. So first, let me explain to you what the 8-4-3 rule of compounding is. So the first question, what is compounding? Compounding interest is often referred to as interest on interest. Unlike simple interest, where you only earn interest on the initial principal amount, compounding interest lets you earn interest on both the principal amount and the accumulated interest from previous periods. Let's see one practical example. Imagine you deposit $1,000 into a savings account that offers a simple interest rate of 5% per year. This means each year you'll earn 5% interest, which is $50, the $5 of your capital amount. So the first year, your initial deposit is $1,000 plus $50. So your total balance at the end of year one is $1,000 principal plus $50 interest equals $1,050. With compound interest, however, the interest earned is added to the principal amount, and then interest is calculated on the new, higher balance in subsequent periods. It's just like a snowball effect. If you drop a snowball from a hill initially, it looks very small. However, the more it goes down, the more snow it gathers, and finally at the end of the destination, it becomes a huge ball. That's the power of compounding. Your money grows exponentially, not just linearly. Okay, so after going through the basic concept of compounding, let's understand what is 8-4-3 rule of compounding. But before that, make sure to tap the like button. This kind gesture hardly takes a second, but it will be the greatest favor to our efforts. Okay, now let's break down the 8-4-3 rule. So first of all, number 8. This represents an 8% average annual return on investment ROI. This is a realistic target for many investors because it considers two factors: capital appreciation and dividends. Capital appreciation refers to the increase in the value of your investment over time. Dividends are regular payments distributed by companies you invest in, providing a steady stream of income. An 8% ROI allows you to benefit from both growth and income generation. Additionally, 8% return is something that anyone can achieve easily and practically, so that makes this wealth-creating game more interesting. Now let's talk about number 4. This signifies the importance of a long-term investment horizon, specifically at least 4 years. Financial markets can experience short-term fluctuations. By staying committed to your investments for at least 4 years, you allow them to weather these ups and downs. More importantly, a 4-year time frame gives compounding enough time to truly work its magic. Compounding refers to earning interest on your interest, meaning your returns snowball over time. The longer you stay invested, the greater the impact of compounding becomes. Number 3. The number 3 highlights the importance of diversification across 3 different asset classes. Diversification is a risk management strategy that involves spreading your investments across different asset categories, such as stocks, bonds, and real estate. This helps mitigate risk because if one asset class performs poorly, the others can potentially offset those losses. By diversifying across 3 different asset classes, you create a more balanced portfolio that is less susceptible to market volatility. The 8-4-3 rule emphasizes the key principles of successful investing: targeting a reasonable return, holding your investments for the long term, and managing risk through diversification. While the specific numbers may vary depending on your individual circumstances and risk tolerance, this rule provides a valuable framework for building wealth through compounding. Before I tell you how to apply the rule of 8-4-3 in real life, let's have a look at a few benefits of utilizing the 8-4-3 rule. Early start. The earlier you begin investing, the more time your money has to leverage the magic of compounding. Even small, consistent investments can snowball into a substantial amount over the long term. Imagine starting to invest Rs. $5,000 per month at the age of 25. With an average annual return of 8%, by the time you reach retirement age at 60, your investment could potentially grow to over Rs. 1 crore. This highlights the power of starting early and allowing your money to grow exponentially through compounding. Goal setting. The 8-4-3 rule acts as a roadmap, helping you set realistic and achievable goals for wealth building. By understanding the potential growth rate based on the rule, you can tailor your investment strategy to align with your financial aspirations. Do you dream of retiring early or achieving financial independence? Knowing the potential growth trajectory through compounding allows you to calculate how much you need to invest regularly to reach your goals. This empowers you to make informed financial decisions and chart a clear course towards financial freedom. Motivation. Witnessing the growth momentum. Witnessing the exponential growth of your money due to compounding can be incredibly motivating. Imagine checking your investment statement and seeing your money doubling every few years. This tangible evidence of progress fuels your motivation and encourages you to stay disciplined with your investment plan. The excitement of watching your wealth accumulate can become a powerful motivator to keep contributing and resist the temptation to withdraw funds before your long-term goals are achieved. The 8-4-3 rule serves as a constant reminder of the potential rewards of consistent investing and the power of compound interest. Now that you understand the power of the 8-4-3 rule, let's translate this knowledge into concrete actions to supercharge your financial journey. Start early. Don't wait for the perfect time to begin investing. The sooner you start, the more time your money has to benefit from compounding. Even small contributions can make a significant difference in the long run. Consider setting aside a fixed amount each month, regardless of the amount. Consistency is key. Starting early allows you to leverage the power of time. Remember, even small amounts invested consistently can snowball into a substantial sum over the years. Invest regularly. Building wealth requires discipline. Set up a recurring investment plan (SIP) to ensure you contribute a fixed amount towards your investments automatically every month. This approach removes the temptation to delay or skip contributions and enforces a consistent savings habit. By automating your investments, you ensure you stay on track with your financial goals, regardless of market fluctuations or your current financial situation. Reinvest earnings. Resist the urge to withdraw your investment earnings. Instead, reinvest them to accelerate the compounding effect. Every rupee of earnings you reinvest becomes part of the principal amount, generating even more interest in the future periods. Think of it as adding fuel to your wealth-building engine. By reinvesting your earnings, you maximize the potential for exponential growth through compounding. Seek professional advice. While the 8-4-3 rule provides a valuable framework, consider seeking professional financial advice. A qualified financial advisor can help you assess your risk tolerance, create a personalized investment plan aligned with your goals, and navigate the complexities of the financial markets. Their expertise can help you select suitable investment options that align with your risk profile and long-term financial aspirations. Remember, a financial advisor can be a valuable partner in your wealth-building journey. Before making any final decision, please consider these. The 8-4-3 rule is a powerful tool for understanding the potential of compounding interest. However, it's crucial to approach it with realistic expectations and a comprehensive investment strategy. Here are some key points to consider. Market fluctuations. While the 8-4-3 rule assumes an average annual return of 8%, achieving this consistently is not guaranteed. Stock markets and other investment avenues experience periods of volatility, with ups and downs along the way. There will be years when your returns exceed 8%, and other years when they might fall short. It's essential to maintain a long-term perspective and understand that short-term fluctuations are inevitable. Risk tolerance. Different investment options carry varying levels of risk. High-growth stocks may offer the potential for significant returns, but they also come with a higher degree of risk. On the other hand, bonds generally offer lower risk, but also tend to generate lower returns. The 8-4-3 rule doesn't factor in risk tolerance. It's crucial to choose investments that align with your comfort level and risk appetite. A balanced portfolio that incorporates a mix of asset classes can help mitigate risk and provide a more stable foundation for growth. Investment strategy. The 8-4-3 rule is a simplified model that serves as a helpful starting point. However, building a successful investment strategy requires a more comprehensive approach. Consider factors like your investment horizon, how long you plan to invest, your financial goals, and your risk tolerance. Diversification across different asset classes, stocks, bonds, real estate, is a key principle to consider. This helps spread your risk and reduces the impact of any single asset class experiencing a downturn. So guys, this is it for today. I hope this video will help you in your journey of cheating wealth. So please make sure to tap the subscribe button and don't miss hitting the tiny bell icon. Thanks for watching.